There are not enough words to describe how important Scott Malpass is to CIS, not to mention the incredible impact that Scott and his Notre Dame investment team had, making possible so many scholarships and mission enhancements for the university. Scott is our founder, our board chair, lifetime MVP, and the best advocate we have for our mission. So Scott, thank you. Get out of your way.
Well, good afternoon, everyone. I've really enjoyed the panels. Thank you for all who have participated so far, and the moderators and the questions. It's what an incredibly engaged group. So thank you for being here. Thanks for your support over the years, for your friendship, and hang in there. One more panel today, and then I saw our featured dinner speaker has arrived from Europe, so I know we're good for dinner as well. So. Let me just start, global equities is a complicated asset class. And there's a love affair with private markets today, which most of that is justified. But if you really think over the decades, where has wealth been created? Most investors have really created their wealth in equities, in stocks, right? Private markets, in terms of access, more broadly, is a pretty recent phenomenon. I would argue there's only a few dozen organizations in the world that can really identify, access, manage a large private markets portfolio. It's very challenging. Staffing, compensation, governance, there's a lot to it. I'm glad, though, more recently it is more accessible to smaller investors. As most of you know, I'm on the board at Vanguard. I work with Fran and Jack, and we have a private equity offering to some of our high net worth clients now. That's our first toe in the water in that regard. It does not scale as much as stock markets or real estate markets, but I do think it's an important component in a multi-asset portfolio. But I do think stocks today are a little bit, the unwanted asset class because of the volatility in some ways, and a lot of confusion about active and passive, and what geographies should I invest in, and how about emerging markets with China and India and a lot of the changes going on in the developing world. So there's a lot of challenges, a lot to consider. But they have been a terrific long-term inflation hedge. People ask me, during my career, there were little bubbles of times when people were worried about inflation, and they'd say, what are you going to do about it? I said, well, I'm going to own stocks for the long term. And so the short term is very hard to predict with inflation. It's hard to hedge. But I always knew that if I own a basket of equities, public and private, that I would earn high real returns over time. So there's a lot of terrific advantages in investing in global equities with all the various sectors, all the different geographies. It also allows you to participate in innovation. Once the venture capital firms start these companies, then they go public. Think about some of the great companies, and Chris and Freddie and Belinda will talk about some of these, but think about the amount of money people have made in stocks like Microsoft and Amazon and Apple and Google and Walmart in the day. And you can think of the different decades and the big winners those decades that were tremendous successes. So there's a lot of reasons to want to have a really well thought out basket of global equities in a portfolio. They're very liquid. Despite the volatility, they are very liquid as well. And most of you are spending institutions, and so liquidity is very, very important. So at any rate, despite all these challenges, we're going to talk through some of the ways we might approach them, and I'm delighted to have with me today three distinguished professionals in the asset class, and I'll just briefly mention them and how I know them, and then we're going to hear more about them and their firms and talk about some of these topics. First of all, Chris Begg, to my left here. I've known Chris many years. I partnered with him at Notre Dame. I'm partnering with him in my new venture. He's the CEO, CIO, and founder of East Coast Asset Management. Chris does a fabulous job. He's a terrific stock picker. He'll talk more about his philosophy. I also like that Chris is so committed to the profession He's a lifelong learner. I don't know how he finds time, but he teaches in the Heilbronn Center at Columbia University, the Graham and Dodd Investing Center, which is world-renowned. I hear from his students now and then, kind of randomly around the street, about this guy, Chris Begg. So he's giving back in a big way, but just a tremendous thinker about stocks and what works in investing in equities. Freddie Late, who's in London. Can you hear us, Freddie?
I can, yeah.
Fantastic. Thanks for joining us. I've gotten to know Freddie over the last year. He's a portfolio manager at Latitude Investment Management in London. Also runs a more concentrated portfolio globally. So Freddie's really helpful thinking about some of the macro issues that we're all dealing with, so we'll come back to him on some of those. And then also another new friend, Belinda Wong from Wellington Management Company. Belinda's one of their senior analysts, also is running a little incubator fund. Besides, by the way, she covers all things travel. So later in the session, if you have any questions about airlines or your problems with airlines or anything travel, this is your lady right here. She knows these things incredibly deeply. So thanks, Belinda, for stepping in for us and helping us. Let me just kick it off then by asking each of you in turn to just talk a little bit about your firm and the history and kind of, a little background. And when people hire you, why do they select you? What about your firm and your approach is so appealing to investors? So maybe Chris will ask you to start.
Great. Thanks, Scott, for that intro. It's wonderful to be here, so I really appreciate it. So I co-founded East Coast Asset Management. Can you hear me okay? Around 2009, and prior to that, I was with a firm called Moody Aldrich, and then another firm called Boston Research, and that's how I started my career. But East Coast was really founded on the premise of, how do we compound capital for ourselves and our partners, at the highest rates of return over the longest period of time, by really adhering to, value investing principles that have been proven, and also to move those value investing principles forward into looking at exceptional companies, and thinking about those companies as if we owned them outright, and kind of aligning ourselves as business owners alongside the operators. And that continues to be what my partner Scott and I do. Right now we have 7 companies in our portfolio. We're concentrated long only in the public equity market, and we just want to go to work every day trying to do good research and unearth the next big idea, which to us could be one great idea makes for a very good year, maybe 2. We're just trying to find great companies that we can own over a long duration.
And Chris, what made you first interested in investing?
Yeah, when I graduated my undergrad, I had already kind of had an inkling that I wanted to be an analyst, and started to study everything I could about investing, and was kind of going one by one on things that made more sense to me. And I was lucky early on to discover, the early Berkshire Hathaway annual letters, and kind of made my way through all the annual reports and realized compared to anything else, this made sense. It made business sense, and it was just the temperament with which Warren and Charlie had allocated capital over the years. So I knew I was kind of going in the direction of value investing, and just started to try to hone my craft and studied businesses, read annual reports as much as I could. So I say the first 10 years of my career was very much about just building knowledge, building pattern recognition, to hopefully kind of go into the next phase, which was really having an active role to allocate capital for behalf of partners, and having the right temperament. So that's how I started.
There are rumors that Chris's birthday party last year was at Charlie Munger's house. Is that true?
That is true.
So he must be a hardcore value guy.
It was a big birthday. It was a big round number.
Freddie, let's turn to you and bring you in here. Talk a little bit about Latitude and kind of its history, and what's sort of distinctive or unique about Latitude.
Yeah, thanks for having me again, Scott. So we started Latitude 7 years ago. It's based in London. It's a global long-only firm. Consider ourselves reasonably concentrated, but not as concentrated as Chris. We have about 23 stocks. They're sort of large cap compounding winners as well. And I think one of the key things that differentiates us is we are looking for businesses that are growing, but applying that kind of valuation framework on top. And the second thing that I would say makes us stand out a little bit is that while it is quite concentrated, we're trying to find pockets of interesting ideas from around the world and the best-in-class businesses, whether that's maybe some industrial companies from Europe or obviously a lot of businesses in the US as well, but thinking quite broadly about where we find these next sort of winners. So I think those are the kind of key differentiating points. And yeah, we've been going 7 years and it's been a great journey so far.
Thank you. And Belinda, you're more of a senior analyst, but you are managing a small fund now. The one thing about Wellington that's terrific is people can be lifelong analysts there. A lot of them don't really aspire to be a portfolio manager. They really love digging into an industry and really understanding that industry. So it has that culture. But maybe talk a little bit about the firm and its history and kind of how you organize the research.
Sure. So before I get into that, I just wanted to add that I also cover telco. So if you have any problems with Verizon or AT&T or find their commercials,
we don't have enough time for that.
If you find their commercials annoying, just let me know and I'll relay the message to their management. But as far as Wellington goes, I'm not sure if Andrew or Roberto mentioned our history, but the firm was actually started in 1933 by an accountant in Philadelphia, and he actually launched the first mutual fund, and it was very unique back then because before he launched the first mutual fund, it was just an era of closed-end funds, so that was very unique. In 1966, modern-day Wellington was formed when, I'll call it old school Wellington, was merged into an upstart firm in Boston that was founded by 4 friends who met on a weekly basis, even though they all worked at different investment firms. And I think that that's important to highlight because even though the firm today is quite large with $1 trillion in assets serving over 2,000 clients from 17 offices, that culture of weekly meeting, that interchange of ideas, of respectful debate, that is very much a part of our culture today. We have 2 meetings every single day where any member of the firm is free to participate and share their views. And it's that culture of collaboration across colleagues around the globe, investing in different asset classes that allows us to do what we do, running a much more diversified fund than what Chris would probably do. We have about 100 names in the Global Opportunistic Value Fund, and our edge in investing in these companies is based on our long-standing, enduring relationships with our companies, where myself and other colleagues will meet with a certain set of companies every single quarter over at least a period of at least 10 to 15 years.
Belinda, that structure's become increasingly rare today.
Yeah.
You saw more of that years ago. Maybe just how's that been able to persist at Wellington?
It's been able to persist because Wellington believes very strongly in the Confederation of Boutiques. And what we mean by that is there's no CIO. It's a firm that has a variety of different investment styles. And the reason why we do that is because we deeply believe that to excel at what you do, you need to invest in a manner that's authentic to who you are. And it means different things to different people, and we want to give investors outlets, whether it's in equities and fixed income, sustainable investing, a way to express who they are in their portfolios. And so channeling that authenticity into how we invest is important to the firm, and it's something that we actively invest in.
Great, so let's shift a little and dive a little deeper into investment philosophy and portfolio construction. And maybe Freddie, you could kick off this part with a little more in-depth discussion about your philosophy, how it's changed over time, and kind of how you also organize your research and stock selection and so forth.
Yeah, sure. So I think in terms of philosophy, I guess it is interesting to go to the start, and I think a lot of people have a similar journey. But when I first started in the industry, I've got a maths degree, and so my original insight and excitement was really led by the financial analysis. And that seemed to me like an X-ray on a business. You could get into the annual reports, get into the details, build the models, and you could learn this sort of structure behind the business that was invisible prior to learning that. And so that was a fascinating sort of 5 or 6 years. But after that, you realize you have to put some flesh on the bones. And we now at Latitude certainly put at least as much emphasis on the immeasurable competitive advantages. You can analyze them, but you can't you can assess them, but you can't really sort of score them in a numeric sense. And I think we've lent more and more into that over the years and believe that a lot of the things you can't measure are actually more important in these businesses, and really getting to know them, really getting under the skin of them and their competitors and the environment in which they operate helps us enormously when we are making forecasts or estimates of the future and the durable power of earnings coming through at an individual sort of stock level. So that's kind of the way we do the work is over a number of years. We normally look at a company for 2 to 5 years before we invest in it. So we're not trying to find a hot stock or sector. We're trying to have these businesses lined up that if we get the chance to invest in at a good time, we can be patient. And then when it comes to the portfolio construction, there's a slightly different philosophy in the sense that the way we need to put these businesses together comes down to the same kind of value theory of an individual business, that over the long term, your return is going to be approximately equal to the earnings growth of that business, which tends to be fed from return on capital, but can come from other sources. And so thinking about how we put together that sort of earnings within the fund and grow the aggregated earnings at a portfolio level is really what motivates the portfolio construction. We can maybe get into it a bit more, but that's the kind of summary of it.
And maybe talk a little bit more about some of the strategies that you use for idea generation.
Yeah, sure. So again, what we're trying to do is really find these stocks which we can look at for 2 to 5 years maybe before we invest for 5, 10 or 15. And so there's a few initial conditions that we need to sort of dig out early in our analysis in order that we're going to be able to go down that journey with the business. And I think the first thing is really truly understanding what the industry looks like and who the competitors are and what shapes it, what the regulation is, what the customer economics are, all of those sorts of things. And having a sense that it's not going to change dramatically over the next 5, 10, 15 years. So it does exclude some sort of early stage disruptive technologies. It excludes some very concentrated kind of biotech type stocks. Nothing against them, but it just doesn't fit our model. And so idea generation really comes out when someone talks to us about a stock, or we alight on a sector or a stock where something's changing, or the return on capital structure's changing, or the capital cycle's changing. And that gets us interested, thinking a few years ahead, there may be some rubies in the rubble in that sector maybe.
Now, you run a global portfolio. How do you think about kind of geographic and sector allocation?
Yeah, so I'd say 60 to 70% of our businesses, irrespective of where they're listed, are global in nature. And that means they broadly sell 50% of sales to the US, 30% to Europe, and 20% elsewhere, as a rough sort of rule. And so we think much more about the kind of underlying sales exposure, underlying economic exposure of the business. But what we find at a stock level is that there are pockets of excellence. I called it out in my opening remarks, but in Europe in particular, there's some fantastic industrial companies born out really of the kind of German industrial growth of the sort of 50s, 60s and 70s. A lot of family-owned businesses, a lot of very sort of, acyclical industrial type businesses. But for technology, there's very few. You need to be in the US. So I think we're not so much thinking we want at this point to allocate to Europe or to the US, but we're saying, do we find more exciting ideas within technology or industrials, for example? So we think less about it, but obviously the currency is a risk. The listing currency can, in the short term, create a risk for pricing of the portfolio. But over the long term, these companies have dealt with many changes in interest rates and macro environments and currency environments too. And we buy businesses we believe can reprice through that volatility if it comes.
How are your companies managing through a very volatile period like the one we're in now?
Generally good. I wouldn't say all of them, but actually the vast majority are doing well. The inflation's been a net benefit in a very meaningful way to the top line of our businesses. And so far in the last couple of years, the margins have actually carried on expanding. So that's been great. The performance in the last couple of years has been very strong at an operating level from our businesses. But the thing that makes us nervous, and the thing we're really pressing management on at the moment, is the action that's going to be taken when demand softens, which feels inevitable, and how they're going to drive through that. And I think the vast majority of them have this structure in place. They know where their competitors are. They know what their customers need. They generally have very diversified supplier relationships. They have this position of kind of economic rent within the industries they're operating. But we own a couple of banking shares, as I'm sure you know. So they're having a tough time at the moment, but it's JP Morgan and Bank of America, two businesses we wholly believe in. And while the shares may be falling, we can take this opportunity to add a little bit if we remain resolute in those underlying theses.
Maybe we'll come back and talk about some more examples, but turning to Chris and Belinda. Chris, you have a very deep sense, a very clear sense of what you believe in, what you look for. Maybe just describe your philosophy and how you think about that.
Yeah, so, our reason to concentrate is not just for concentration purposes. It's usually we want to understand the businesses as well as we can. So we can't do that with many companies. And also, we typically don't find that many ideas that we want to be, have large positions in at any one time. So that's what drives our decision. So what we're trying to find is three qualitative factors that would meet the criteria of owning 10% or more position in a company. It's first and foremost moat, really understanding what's the sustainable competitive advantage of the company. There's layers of competitive advantage that are really important to us, and there's 8 of them that we kind of articulate in our process, one of which is structural. Oftentimes we'll look at industries that are duopolies, oligopolies, monopolies. They have exclusive right, or they are the Switzerland on top of, say like the public cloud, there's 3 players there. So structural competitive advantages are great. Sometimes we layer on network effects, layer on customer mind share. Sometimes those scale economics can be shared in the way of lower pricing for customers. So all these things layer a moat that's potentially widening over time. The second thing is looking at secular tailwinds. We don't invest in a lot of industries or businesses that face headwinds. Those are, we found, harder to time. So we want to see secular tailwinds. For example, we've had an investment in MasterCard, not right now, but over a good part of the decade. So when you look at secular tailwinds of just moving cash and check to debit and credit, that's probably 5% per year. That's this tailwind that we're enjoying. You look at credit ratings like Standard & Poor's and Moody's, we're enjoying those tailwinds. Third thing is capital allocation. We really want the operators that are kind of stewarding our capital to be good capital allocators. It's not the most important of the 3, but we tend to do better when our operators are actually really thoughtful as far as both their reinvestment, buybacks, acquisition strategies, and so forth. So that's when really has been is where you get all 3. When we're looking at valuing these businesses, we're building a 10-year model. It's a little different, I think, what some of our peers are doing. So we're trying to really think about what's the growth of free cash flow over a 10-year period. And what that does is it makes us think a lot about free cash flow as far as in the current year, in the next 2 or 3, but also what's the interest rate environment over this 10-year period. So I think what happened over the last 3 years when interest rates were near 0 is there wasn't a lot of demand for free cash flow in the near years, and there also wasn't a really good idea of what is that 2-year out or 5-year out discounted cash flow. What is the interest rate that we should use? We were kind of looking outside of that and saying, what should it be over a longer period of time? And I think that helped provide a little bit more discipline in how we were underwriting valuation. So those are the 4 things that drive, kind of what something comes into our universe. About 120 companies that we have done active work, have built models on, that we're kind of monitoring for real-time price changes. So what was said internally is, this company X has hit a 15% IRR. That gets us very excited. We start to, do deeper work with regard to, getting the model updated. But that's kind of a day in and day out is, what is that universe of companies that meet that qualitative criteria? Where are they priced today based on our 10-year IRR? And that's kind of the conversation is, okay, this one's coming up, this one's going down, maybe this deserves to be in the portfolio.
Chris, as you know, a lot of consultants like to sort of pigeonhole or classify stock managers into different styles, whether it's large, mid, small cap, or growth and value, or even within growth and value, there's sort of subcategories. And I think it's confusing to investors. So maybe just a little bit about sort of how should people think about growth versus value today? I think those names mean a lot different things than they used to.
Yeah. I think when you go back and think about value investing from its early days, when Ben Graham wrote, Security Analysis in 1934, or Intelligent Investor in 1948, he was working under the construct as, let's buy these collection of cheap assets at a discount. That's great. Value investing, what I call that value investing 1.0. 2.0 is, I think Charlie, even Warren gives Charlie credit for this in the sense, shouldn't we buy great companies that are growing and buying those at a reasonable price, not necessarily at a cheap price? Now, a reasonable price means the growth of those cash flows over time will compound, and we won't have to sell these. So I think value investing 2.0 really looks at current year free cash flow, yield, plus growth equals IRR. And I think as we get into more innovative companies that have big total addressable markets, Amazon, for example, sometimes those free cash flows aren't apparent in the near years because they're reinvesting in building a logistics and distribution business globally. They're investing AWS. So I think if you think about value 3.0 or value investing 3.0, it is how do we look at free cash flow that may not be optically apparent. Now this is very dangerous because I think the biggest trouble that we got into as value investors or growth investors is that a lot of investors were say, oh, that the free cash flows will be there in the third and fourth year, and they weren't giving us much credit into doing the work to understand maybe this business model is not profitable. Maybe it's not free cash flow generative ever. And I think that's where there's some confusion right now on how much of this value 3.0 is that we can actually truly do that kind of work. We still think there are great companies that may not show near-term free cash flow, but that's going to be not the norm in our portfolio. We love companies that generate lots of free cash that we can measure and see in year one.
I think it's important to remember that the value sectors traditionally were sort of the banks, right, utilities, energy, and those are sectors that haven't really been disrupted in a massive way like you see in consumer and service industries. So that's why the names sort of confuse people a bit today, especially when you're comparing long-term returns between these various indices. But Belinda, maybe talk a little about Wellington and kind of what your philosophy has been, and kind of how you organize your research, what you look for in companies, that might be unique or different than other analysts, that kind of thing.
Sure. So within the context of Wellington, I work on the Global Opportunistic Value Fund, and the way our team invests is exactly the way the name sounds. Opportunistically, we are very attracted to companies that have suffered a significant share price underperformance relative to our benchmark, which is the All Country World Index. When we identify these companies, we basically put them through a screen to narrow down the list of companies, because at any given time, there could be like dozens of companies that are underperforming, now probably even more than that. So to narrow down the list of companies that we spend our time on, we put in a constraint that the company cannot be over-levered. I started my career working for one of the first 8 investors at Oaktree. I started in distressed private equity. And so like my portfolio manager that I work for today always says that the year you start your career really has a big impact on how you invest. And for me, because I started off during the financial crisis and basically was a distressed for control investor and took over companies and fixed them. Like, I do not invest in companies that have over 3 times net debt to EBITDA as a rule, except for real estate, because it does tend to be a more levered sector. And so we put a constraint of low financial leverage. The second constraint we put in is that the company has to trade at a discount to its own historical valuation. We don't do the low price to book value type of investing, because that really constrains you to a certain set of subsectors, and that might not be a recipe for outperformance because the world is changing. And so we look at valuation in the context of a company's own history, not just where it's trading relative to the benchmark. And third constraint we put is, are we and our extended team, which includes the colleagues of Wellington Management, are we able to identify the reasons why a stock has been underperforming? Stocks don't underperform for no reason. And if you're investing in a stock because it has suffered a significant share price underperformance, you need to be able to delineate the 1, 2, or 3 reasons or overhangs that a company needs to address in some period of time so that it can restore itself to what you think the fair value of the company is. And so after we impose those 3 constraints, we zero in and do due diligence on the company. And if we feel very confident that a company can address its share price overhangs in a given amount of time, I would say 2 to 3 years is what we normally target, then we do invest in the company. Because we run a more diversified portfolio, we're okay taking operational risk because we have so many names in the portfolio. And in order to stay disciplined to our process and to eliminate the potential for value traps, before we put names in the portfolio, we delineate a timeline that indicates what does the company actually need to show to confirm that the thesis is on track and at what point in time. And we use the baseball analogy of 3 strikes, you're out. There could be exogenous events that prevent a company from achieving your thesis. So sometimes the KPIs could be off. In my sector during 2020, it was because of COVID. And so our philosophy is that if a company misses your KPIs for 2 times, probably need to eliminate the position because your initial thesis is wrong. And I think sometimes it can be hard for people to admit they're wrong, but we do need to do that to instill discipline and protect the portfolio from value traps. If it's wrong for a 3rd time, what we've observed historically is the thesis is just structurally broken. And so we do implement the 3 strikes you're out by eliminating positions if they miss the thesis for 2 consecutive quarters.
No, great, thank you. Freddie, maybe just weigh in yourself on this sort of growth value question. I know it's something that I get asked a lot about by investors of all sizes, and kind of how someone should think about that today.
Yeah, I mean, the way I look at it is, I've never heard of a great business that isn't growing. Over 20, 30 years, businesses you build grow if they're successful. And so I do understand the sort of, Chris's point on sort of value 1.0, if the assets are worth $1 and you can buy them 50 cents and sell them to someone else for $1, that's great. But to me, buying and backing great businesses, you need them to be growing. So all of our businesses are growing substantially or reasonably, and that's the intention. But you should still always try to pay as little as possible for those businesses. And I think the way we think about it, I mean, to me, that's the whole tension. That's the whole art of portfolio construction. Portfolio analysis is finding those businesses in the first place, building up your watch list, your subs bench, having the 100 or the 20 that you really want to own one day. And then portfolio construction is really a feature of the patience to wait and miss them if they're not at the right value, and to find the way of maximizing your potential today, so your free cash flow today and in the future. So the value today and the growth in the future coming from the same return stream or source of free cash flow. And we say something that I think is sometimes a little bit antagonistic, but we've completely disregarded valuation metrics at Latitude. We don't believe there's a fair price for any asset. It's all relative. And the real challenge for a portfolio manager is finding the relative attractiveness between 2 securities. And a trivial example would be if you think a stock you like, Scott, is worth 20 times earnings, but every other stock in the world falls 95% tomorrow, is your stock still worth 20 times? Or if you can earn 25% interest in the bank, is the market still worth 16 times to you? So I think that relative decision, based around how much free cash flow I can get today and how much I can get in the future, with sort of ranges of certainty and confidence in that, that is the challenge. And it's the sort of 2 sides of the same coin argument, but put slightly differently. So we consider ourselves both.
Freddie, maybe just briefly talk about a current holding that you think best exemplifies your approach to investing, and maybe more broadly, what are you finding interesting right now?
Yeah, so one of our longest standing holdings is a company called AutoZone, which I'm sure you guys are all familiar with. In London, I have to explain it. But it's been a great business. I've owned it since 2009, and it's compounded earnings at around 20% per year. There's a number of reasons we like it, but it ticks all the boxes I mentioned earlier. It's got a very easy to understand industry. There's only a few players. There's only a few big players, and there's a number of small people who are sort of, sadly losing their market share to the bigger guys over time. Very clear capital allocation, very, very clear business model, which is free cash generative, negative working capital cycles, things like that. So that's a really good example because for all of my career, it's sailed pretty much under the radar. It's never been considered a very exciting, growth stock, despite delivering, top decile or above kind of returns to clients. I've done a podcast on it, so you can get more on that one there. Things we're interested in at the moment, I think the majority of the stuff that we're looking at that's sort of bubbling along, and as Chris pointed to, kind of, ticking those IRR targets, or in our view, it's looking really quite relatively attractive to our portfolio, it is the more cyclical end of the kind of industrial, so the less cyclical end of the industrials, capital goods, certain building materials companies, stocks like that. And we do believe that the structural growth and the sort of secular trend behind reshoring and capital replacement and efficiency for buildings is likely to play out over the next decade in a pretty meaningful way. And there's some very high quality businesses in there. I mean, to name a few, there's sort of Acer Abloy, there's some of the house building materials companies like Sika, and then there's about a dozen on our list that we're kind of getting quite excited about. But we're wondering how greedy to be, because it does feel like the market's about to, the economies are probably about to get a bit weaker. But we'll see how greedy we are.
And Chris, how about you? What's something that exemplifies what you're doing, and how are you thinking about things more broadly right now?
Yeah, so also a business we've held since 2009 is a company called TransDigm. And some of you may have heard of TransDigm, but it's an aerospace parts company. And what they do is, like I mentioned, moat, secular tailwinds, and capital allocation. So the moat on TransDigm is they are a sole source provider of commercial airline parts. So if you're on an airplane and you see a latch, that's usually one company. There's many companies that make these parts, and there's usually FAA approval of one company to make that part. And the FAA is pretty stretched, so they can't offer approval to many companies. So it's a safety factor. But it's a fairly good big investment to get on a new platform. Once you're on there, after spending 6 years of due diligence and R&D, you're on there. The platform can last 50 years. So you get this aftermarket, really a creative free cash flow stream. And so secular tailwinds in the industry. You have revenue passenger miles, which is kind of really a proxy for top line growth. Runs about 5%. You can see these products have pricing power in the sense there's no other competitors. So management wants to be smart about that, but you have 5% pricing power. And Nick Halley, who's run the business for the better part of our whole holding period, has just been an incredible capital allocator, to the point where last year he was given the Singleton Prize as one of the best capital allocators. It was given by the Henry Singleton Foundation. And so he's compounded about mid-20s for us over our holding period, and just an exemplar of kind of what we kind of look for. We currently still own it in the portfolio. It's still one of our largest holdings. We had the opportunity to make it an outsized position in March of 20 during the pandemic, when you can imagine the fear associated with owning anything in the aerospace area. So the whole space sold off dramatically. I think TransDigm ended up going from $650 a share to $206 a share intraday in March. Good example of having our work done, having owned it in the past. We were able to move 25% of our capital to the aerospace area over a course of 5 days. So that's kind of what we hope for, in the sense of not having pandemics, but having completed work, understanding of a business. So when you get this opportunity, you can act fairly quickly with some confidence. Right now, also like Freddie, we're kind of doing our work in these deep, what I would call areas that would be perceived to having a lot of recession sensitivity. So things that sell into the home market, things that are involved in commercial real estate, perhaps. These all feel pretty scary and very fearful. So prices are starting to get more interesting. A collection of companies that we would love to own are starting to hit 13, 14% IRRs. 15s are kind of threshold, where we're not putting new money until we think we have a 15 and 10 year. So that's where we're doing our work right now. And I think in general, to us, it feels like there's likely some more volatility, and that we'll be able to take advantage of that.
Now, Belinda, everybody likes to travel. So maybe just a minute on kind of the travel industry and the state of travel today, and what you like there.
Anyone who's come on a plane here probably noticed how expensive airfare is. So I would say that kind of summarizes what's going on with airlines globally. Airlines are a little bit fragile in that the balance sheets are never good, because it costs a lot of money to buy planes. their cost structures. They're basically price takers. So, Chris talked a little bit about moat. Airlines almost have no moat. They're price takers in almost every line item of their income statement, and so it's a little bit tricky. But having said that, a stock that would exemplify how I invest would be Ryanair. For those not familiar with European low-cost carriers, Ryanair is basically in the middle of Spirit Airlines and Southwest. And Ryanair is very interesting because it's one of the only airlines globally that is net cash. It's a name that I have been in and out of for a number of years. It was the first name that I sold the day Ukraine was invaded. And it's the first name I bought back when I knew that travel demand would recover in Europe. The company is really interesting because it's the type of company that succeeds because not only does it have a really good balance sheet, but because it really values different stakeholders in the company. When you look at a company that is an airline, because of their net cash balance sheet, the reason why Ryanair can take so much share from legacy flag carriers in Europe is because their balance sheet basically enabled them to take advantage of Boeing after the MAX accident. So they were able to get planes at a far lower cost than anyone could get other than Southwest. During COVID, they also reached out to all the airports in Europe to get more slots to prepare themselves for the recovery because they knew they had the planes and they knew that their flag carrier competitors would maybe not survive, and there have been bankruptcies in Europe, and so they worked on the airports. But more importantly, it's an airline that actually values its labor, and you just don't see that in the US, and that's actually why airfare is so expensive in the US. It's because the airlines basically furloughed or laid off a vast majority of their senior pilots, and it takes time to become a captain of an airline. And so the US is in a different situation than Ryanair because Ryanair actually maintained the current status of all of their pilots during the pandemic by convincing the unions to agree to a 5 to 15% pay cut, and in return, no one was fired from the company, and that's so unusual compared to what we see in the US, where airlines basically treat their employees as at-will labor. And so for Ryanair, because of the way they manage their balance sheet, because of the way they treat different stakeholders, with labor being a very important element, they have been able to recover much faster than any airline globally. They've been able to maintain, if not improve, their low-cost position. And that's going to enable the company to be one of the few airlines globally that actually earns more today than they did pre-pandemic. And they could potentially be buying back 20% of the company a year as they cycle off their Boeing aircraft deliveries.
So let's move back up to 40,000 feet for a minute. Freddie, I'm going to ask you first, what are your kind of high-level thoughts on equity market valuations today? And where are you seeing the best absolute and relative return on a global basis?
Yeah, I mean, it's always a tricky one. I think the only sort of macro indicators that we really look at from a valuation perspective, I think the CAPE ratio, the cyclically adjusted PE ratio, is probably the most useful one on a long-term basis. I mean, on a short-term basis, markets in Europe feel a bit cheap, and markets in Japan feel about the same, and on a short-term basis, markets in the US look a little bit expensive. But on a long-term basis, I think, actually the prognosis is a bit worse. It points to quite a flat returning decade, 2, 3, 4, 5% returns maybe, in contrast to the sort of 12 to 15 you might have seen around the world in the last 10 to 12 years. So that ratio is one thing that we keep an eye on. And the second thing that sort of influences that, obviously, is the margin structure. Margins went up a lot from a very mean reverting kind of 7 or 8% in 2000, and then they've been trending down. That was when China entered the WTO and really unleashed the kind of cheap capital, cheap labor, and incremental demand story. But since 2010, margins have been falling relatively steadily, and they've shot up in COVID as this sugar rush of demand was met by a lagged inflationary cost pressure. And so we think it's going to be a pretty tricky environment. I would argue that sort of as a whole, probably margins are going to tend down for corporate America in particular. And I think, but America's had growth you've got to remember this. Europe and the UK, for example, may be cheap. They're quite weird equity markets to buy into regionally. The UK, only 10% of sales is actually from the UK, for example, from the FTSE. But there's been almost no growth in underlying intrinsic value. There's been almost no free cash flow growth. There's pockets of wonderful businesses, but in an aggregate level, I'm not sure what price is cheap enough to buy these regions as a whole, because I can't, sitting on this side of the pond, I can't really paint you a positive inflection story for the European or UK economies that's going to outpace America. So not a very good answer, but I think the valuations are probably fair on a relative basis, but maybe there are some the one thing I'd add, sorry, Scott, long answer, is there are some pockets where you find stocks that are very, very similar to their US competitor and genuinely trade at half the price, but with no lower level of quality or potential, and in fact, they're global businesses. So we do invest in some of those, and what you're seeing at the moment is rather sad for UK PLC, but quite a lot of businesses trying to list in America to get the ratings and the attention that they get over there instead of staying in the UK. So there are pockets of that, and that's being kind of arbitraged out by the management teams.
And how heavily do you weigh sort of geopolitical pressures and currency shifts in your analysis?
We think about it a fair bit, and we like to think about the sort of longer cycles, again, part of that kind of rebuilding and maintenance CapEx boom potentially, and reshoring is sort of, it's the other side of the hill of that China story from the early 2000s, and indeed 94 or whenever it was they devalued originally. So, we think about those long-term sort of geopolitical situations, but and the structural trends it can give you. But we don't take any view on when the war in the Ukraine is going to end or when other things are going to flare up. We try, we are concentrated, but we try not to have too much exposure to any one risk that's out of our control. But, we're going to be, as equity investors across the world, are going to be more exposed to it. You can buy the highest quality airline. Those two airline and airline related stocks are very, very high quality businesses that Belinda and Chris have just mentioned. But a geopolitical thing like a war or a pandemic or whatever it is going to affect them in the short term and plausibly in the long term. And that's true for everything. That's not a criticism of those stocks. It's just saying you've got to keep, we like having 25 stocks exposed to different things so that if one of those comes along, it doesn't impair your capital too much.
Chris, same to you. Where are you seeing equity market valuations today?
Yeah, so the 125 companies that we're tracking real time on 10-year IRR, I'd say in aggregate, it's about a 10 to 12% IRR. So we kind of consider that in a range of being pretty fairly valued, kind of looking at historical equity returns. And, in a concentrated portfolio, we can find, hopefully the 7, 8, 9, and 10 that we think are ranged higher because they have, micro clouds over the businesses that, are creating some opportunities that we think are, for a longer term investor are rewarding. I had Todd Combs visit our class in the fall. We were about similar valuations, and he shared that, when him and Todd, who works with Warren Buffett, when they have lunch on Saturday, they kind of do this thing where they say, what do you think about equities, 0 to 10? And so his answer that he shared with the class was, it was a 5. And so it kind of maps kind of what we're thinking. We're about a 5 here on this kind of range. When things get closer to 20 IRRs, we get, that's a 10. That's where we get real excited. Probably 8s, 9s, and 7s, you start to think this is really overpriced. Now, remember, the long duration equity that was very overpriced starting kind of going into 2022 is down 50 to 70%. And it's still not that attractive. A lot of those companies to us just aren't that attractive. They're still trading at pretty high valuations. The path to free cash flow still isn't clear to us on a lot of those. So it's just an observation. And the second part of your question was?
Just where you're seeing opportunities today going forward.
Yeah. So the two clouds that usually present really great buying opportunities are macro clouds where you see big market sell-offs. We have plenty of macro clouds right now. You got potential of higher interest rates, inflation. We heard higher for longer. 5% inflation compounded is a real problem, And particularly if we go into a recession, you start to hear a scary word, stagflation. That concerns us. So things that are related to or have exposures to global macro headwinds and these clouds, we think are going to present opportunities for long-term investors. Micro clouds is where we're mostly invested, and that's where there's a perception about a company's near-term uncertainty that's weighing on share price. We own a company that's very similar to TransDigm. It's a sole source provider of fire retardant. So anytime you see fire retardant being put onto a wildfire, that's typically one of our products from Perimeter Solutions. Last year, which is a good thing for trees, it was a bad fire season. And historically, we have a data set going back 40 years. We're going to get a bad fire season every once in a while. So that weighs on share price. Again, long-term investor looking to own this over a 5-year plus holding period. This is kind of the things we look for to take advantage of.
We'll get to questions in just a minute, but maybe Belinda, how does ESG inform the investment process at Wellington?
So it'll vary based on the fund within Wellington, but for us, similar to how we don't shy away from companies that are underperforming, we also don't shy away from companies that have really low ESG ratings. And the main reason why is because we believe that through our partnership with our companies that we might be able to help them rectify ESG ratings that are either wrong or outdated. Ryanair is actually an example of one where we have worked with them in their engagement with MSCI so that they could correct their wrong ratings, especially on the S pillar of ESG, where they're being penalized for a strike that happened 5 years ago, and the Moody's analyst wasn't recognizing that Ryanair was one of the only airlines that didn't lay off any employees during COVID. And so we don't shy away from ESG. Another example that's relevant would be Tyson, where the company had really bad S ratings, and at the beginning of the pandemic, they couldn't maintain their labor. So they had high degrees of absenteeism, people quitting, and it actually reminded me a lot of what I saw in Japan, which has struggled with demographic problems well before we saw them in the US. And something that we saw in Japan that really helped companies attract labor was building daycares or health clinics on campus and making it easier for employees to access things that they really needed. And so we proposed these ideas to Tyson, and they actually did implement some of them. So they immediately raised their wages, they put in more safety protocol, and they included health clinics on some of their campuses so that employees could get tested or vaccinated if they wanted to. And the absenteeism problem actually fixed itself really quickly. And so those are examples where the companies on paper look really bad on ESG ratings. They're ranked very low, but through our work with the companies, we help them, and I'm sure other shareholders would help them too. We help them rectify these problems, and hopefully their ratings will improve, but more importantly, their operations will improve because they've addressed something that could be improved in their business.
Great, thank you. And just finally, and then we'll take a couple questions. Freddie, a lot of people are concerned about the emerging markets today, particularly China. I happen to think there's a massive recovery that's going to be starting in China post-COVID. Could be a very interesting investment opportunity. However, there's a lot of geopolitical concerns, obviously. And just kind of just on an investment basis, how should investors think about China today?
So I think you're right. I mean, the companies we talk to, and whether that's luxury goods companies in Italy or some travel companies in Europe, they're certainly seeing Chinese demand come back. And what they really have is this kind of concept of excess savings that we've been talking about in the Western world for the last couple of years, just being unleashed a little bit later, alongside some stimulus from the government over there. So they are aiming for lower growth rates, but it's still a very positive impulse into the world economy at the moment. We don't invest in emerging markets directly. That's really a circle of competence thing. But I do feel like over the next 10 to 15 years, we will see other issues like Russia, not meaning that we'll necessarily see other physical wars, but we'll see other major escalated tensions. And that may or may not come in with China, but it could come elsewhere. And I feel like it's an area you're going to have to really understand the geopolitical risk if you're locking up meaningful amounts of capital in a different jurisdiction. I think that's more the concern I'd have. I do know people who invested globally and had Russian assets, and they're sort of still frozen and written down, and it's a very difficult scenario to get your capital back. And if we enter a world of, slightly more friction around capital transfers, which is plausible, I think that would be the concern I'd be looking at. The underlying economic story and the growth in the middle classes and the sort of tertiary to primary industrial sort of production and then consumption story in China, I think holds true. So from a local perspective, I think it's attractive, but I think I'd still be a little bit wary from a global perspective.
Okay, let's turn it over to the audience for any questions, please. Covered a lot. Yes, sir.
Yeah, panel was excellent. Scott, this might be more for you. There were so many good perspectives, but there was talk about not disregard, but not a bias towards geography, and then sometimes for growth versus value and large versus small cap. Coming from the environment that you were in at Notre Dame, how do you view that, and how does that impact like what you ultimately want to accomplish from a return and risk budget perspective?
Yeah, for stock pickers, our thinking did evolve over the years. I mean, 30 years ago, you did think of managers more in the large cap and small, mid, and they even had SMID and, and micro cap and all these various buckets that consultants created. We went entirely away from that, really, and really just focused on skill. Just there's first of all, it's hard to find it. Sustainable alpha in equities is hard, there's no question. So really gravitated more just if we could find a handful of stock pickers who had some real skill, a real edge in what they did. It was endurable, it was enduring. That's more what we focused on. And it wasn't so much about how much in large and small or growth and value. We were very aware of it. We had all the analytics you could want to just kind of evaluate it. But ultimately, it was so hard to find alpha that that's really what we focused on. And we ended up hiring, a lot smaller firms, more concentrated, less assets to manage. The opportunity for them to earn higher alpha over a benchmark we think was greater. And we had some good success with that. But that's kind of how it evolved over the years.
Thank you. Terrific panel, I thought. And I was interested. I'm in the private markets, and the way all of you talked about the way you think about investing seemed a lot like what we do in private equity. I was really intrigued by that. Mm-hmm. Specifically, Belinda, you talked about the 3 strikes on KPIs. Are these KPIs that you guys are coming up with for companies, or are these ones that management creates and communicates to you?
It's usually what we track ourselves. They're not always KPIs that are reported by the companies. It could be KPIs that through data scraping that we ourselves track. And the reason why we have, I call them like pre-indicator KPIs, is because you need to be involved in, well, we believe that we need to be involved in the stock before the inflection comes. And sometimes the data that we track is not the data that is reported by the company, but things that would materialize maybe through like browser searches for a specific key term or traffic to a website that is not captured by the company but would be captured by our alt data.
Anything else? Okay, let me just conclude by asking a couple quick questions. One, Chris, S&P 500 level by year end and the Fed funds rate. S&P 500 and Fed funds.
Oh my goodness.
Oh.
Well, I think from here, I think the last I looked, S&P was up 3.5%, 4% for the year. I think it closes up 10%.
Okay. And Fed funds?
I think 75 basis points higher.
Higher. Freddie, how about you?
I always give the same answer to this question. It's whatever it started the year plus 8%. So I guess we're a quarter of the way through. So 4,200 on the S&P. Okay. And Fed funds, Pat, 475 maybe.
Okay. Belinda?
I think flat, so 4,000 and probably 5%.
Okay. All right. Thank you very much, everybody. Thank you.